The game is not over. The game is just beginning. Watch the spreads. That silver is about to do, again, waiting on that trigger level, spread, silver, gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market. And especially the miners are a tiny little market. You move much money from the stock, but look what's happened to GDX recently.
The game isn't over. It's only just beginning. Veteran analyst Michael Oliver says silver is standing on the edge of a revaluation so explosive it could permanently change how gold and silver are priced. While most investors think the bull run has gone too far, Oliver insists we haven't even started the real move yet. He warns that a massive capital shift is coming, out of an inflated stock market and into hard assets like gold and silver. And with silver's supply squeezed tighter than ever, the next breakout won't be gradual. It'll be violent. Right now, gold has just cooled off after blasting through $4,400, sitting near $4,001, while silver recently smashed above $50 and is hovering around $48.30. Central banks continue record gold buying, and industrial demand for silver, from solar, EVs, and AI chip manufacturing, is hitting all-time highs. Yet, according to Oliver, what's about to happen next could make those price levels look tiny. This isn't the end of the bull market. It's the ignition point of a new reality.
And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back in its 79 peak, 1980 peak in gold, and at the 2011 peak in gold, it had an eightfold bull market to get to those highs. We're only fourfold right now. When that spread breaks out, it says something's beginning, okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important, and that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since, actually go back 11 years now, about from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. It's now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake, okay? But you can see it in the hourly ticks where the short-term traders say, S&P just dropped 5, let's sell silver off, because it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take, for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So the S&P had a sharp cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up, okay? So people need to rethink that assumption because it will trap them into missing something if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, you go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production. Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver.
Michael Oliver's message cuts straight through the noise. Stop focusing on day-to-day price swings and start watching the spreads. The performance of gold versus the stock market and silver versus gold. These spreads, he says, are the heartbeat of the next financial transformation. Oliver explains that the gold to S&P 500 spread has been quietly coiling since 2013, hitting the same resistance multiple times. If gold ever closes a month above 60% of the S&P's value, it will break a decade-long ceiling, signaling an asset class rotation unlike anything seen since the 1970s. That's the moment when capital leaves overvalued paper assets and races into tangible money, gold and silver. When that breakout happens, he says, it's not a sign of exhaustion, it's a sign of ignition. At the same time, the silver to gold spread is preparing for its own historic breakout. Oliver stresses that when silver breaks relative to gold, it doesn't move in smooth, linear steps. It erupts. The 1979 to 1980 and 2010 to 2011 surges both saw silver rise several-fold in months, not years. Based on current spread behavior, he believes the same setup is repeating now. What makes this moment even more explosive is the global market backdrop. The Federal Reserve's rate cuts have reignited inflation pressures, major economies are sliding into recession, and U.S. deficits are ballooning toward $2 trillion annually. Meanwhile, the dollar index is losing global confidence, with BRICS nations now openly trading oil and commodities in non-dollar terms. This loss of faith in fiat currencies, Oliver argues, is exactly what pushes investors toward real assets. He dismantles a popular myth that silver must fall when the stock market crashes. History proves otherwise. When the S&P plunged 20% in past downturns, gold rallied. Silver may lag briefly, but when the panic turns to fear of currency debasement, it leads the surge. Today's stock indices, dominated by a handful of mega-cap tech stocks, are a distortion machine, he says. Once those topple, the capital flow into precious metals could be violent and unstoppable. Then there's supply, or the lack of it. Roughly 80% of all mined silver is a byproduct of copper, zinc, and lead extraction. Even if silver doubles in price, those miners won't suddenly produce more. This creates a unique imbalance, soaring demand with zero elasticity in supply. Add to that the relentless industrial consumption from solar manufacturing, China controls 80% of global panel output, and AI-driven electronics, and the shortage becomes structural. Oliver calls silver's long-term $50 ceiling a psychological illusion. Adjusted for inflation and decades of dollar dilution, silver would need to reach $200 an ounce just to match its past highs in real purchasing power. Meanwhile, gold's current fourfold rise from its bear market low still falls short of past eightfold surges, meaning this bull cycle has miles to go. This isn't the end, Oliver declares. It's the early innings of a global reset. The old rules won't apply, momentum will break through, and silver will finally enter a new reality zone, one it should have reached decades ago.
Spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at. See silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you can do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is this or that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous. I'll comment on that in a minute. $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver is just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also if you go back and look at 1980 high 50 or 2011 at 50 and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market. And especially the miners are a tiny little market. You move much money from the stock, but look what's happened to GDX recently. Would we go from 40, 50 up to 80, $80? Bam, like that. That's a new reality. And therefore, the action of these other categories is very important to further fuel the monetary metals.
So, could we be standing on the edge of the biggest revaluation in precious metals history? Michael Oliver thinks so, and he's backing it with data, not emotion. The next leg up in silver could shatter its old price identity and force the world to reprice what real money is actually worth. Question for you. Do you think silver will finally break out and hit $100 or even $200 an ounce? Or will central banks and the Fed step in again to suppress it? Drop your thoughts in the comments below. I want to hear your take. If you found this breakdown helpful, don't forget to like, share, and subscribe to the channel. Turn on the notification bell so you don't miss the next update, because the biggest transformation in gold and silver since the 1970s could be right in front of us.